Hey, everybody, and welcome to this Saturday EB Weekly Market Recap video. First of all, I want to say thank you for being patient. Last week, I know I had to go out of town, so wasn't able to get this weekly market recap posted for you. But we're back this week, and we're ready to take on, the month of May. Got a lot going on. I mean, last week there was so much to talk about. I'll go over a couple of things very briefly. We got the jobs report out on Friday. That was really good in the sense that jobs came in much well below expectations. So the March report was revised higher up to 315,000 jobs, and April came in at 175,000, which was below consensus and also below that upwardly revised March number. So it's good in the sense that, first of all, it's positive jobs. So it continues to show that our economy is resilient and so forth, but it's not too hot. It wasn't hotter than expected. And so that gives the Fed maybe a little bit of wiggle room to work in potential rate cuts down the road. I mean, that's what we want to see, because if we get a hot number, then it starts looking like the economy could be overheating, and you don't want that when you're trying to battle inflation. So I thought this was kind of a Goldilocks kind of a number that came in on the jobs number on Friday, which I think will help us potentially down the road. And the market reacted in that way. We saw a big gap up on Friday. That also was accompanied by a nice earnings report out of Apple, better than expected. And that combination really got the market going on Friday. But we had the Fed meeting out earlier in the week. They met Tuesday and Wednesday. They had the announcement on Wednesday at 2 o'clock, stating the obvious, that the Fed funds rate would not be adjusted. We were leaving it alone. And the Fed did make one comment, which, I thought was maybe just a little bit dovish, saying that the likelihood of the next move, the next rate move being higher, was unlikely. And Fed chief always likes to throw a little nugget in there, one way or the other, either bullish, bearish, hawkish, dovish, whatever you want to call it. But this time he kind of threw a little bone to the bulls and said, I don't see a rate hike coming, because there'd been some talk with inflation remaining stubborn, that maybe we might have to hike again before the rate cut started. And I thought Fed Chief Powell kind of squashed that. And of course, next month, who knows, what he says in June. But at least for now, I thought he gave the market a little bit of relief. And that certainly helped, what we saw last week. I will say also, S&P 500 dropped over 4% in the month of April. And that followed 5 consecutive months of gains. If we go back to November and December, January, February, March, the S&P 500 had gained about 25%. So while it felt bad in April, let's keep things in perspective. We always need to have a healthy dose of perspective. And I think after 5 months going up 25%, giving back 4%, not really that big a deal, to be quite honest. Talked about that maybe happening back in March, April. And instead, it got pushed back to the very end, or excuse me, February, March. But most of that weakness came during the month of April, a little bit later than what I expected, but still taking us back down a little bit below 5,000. That was one of the things I'd called for back at the beginning of the year. I thought we would have a rally to open the year, then we'd go back down below 5,000, and then we'd start to rally back up. Is that bottom in? That's a great question. I think with the rally that we had, I think the odds now have certainly grown that we're not going to go back down and put in a lower low, but we are not out of the woods by any stretch of the imagination. So I'm starting to turn a little bit more bullish short term. Of course, long term, you should know if you've been following my show, I'm very bullish. I believe this is all part of a secular bull market, no different than the sideways action and a little bit of weakness we saw in 2015 and early 2016, no different than the trade war at the end of 2018, no different than the pandemic in 2020, or the cyclical bear market in 2022, the correction in 2023. All of those periods were bad, but they've all been part of this secular bull market. And I think we still got that in play. And I believe we're going to be talking about new all-time highs. later this year. And in fact, by the end of the year, I think the market's going to be on quite a run to the upside. So nothing really changed there. We did have a lot of earnings reports. We'll talk about a few of those later in the show. Obviously, the Apple report on Thursday after the close was big. And so the market, I think, digested that in pretty solid fashion. 10-year Treasury yield as a result of the Fed and as a result of the jobs report, we've seen the 10-year Treasury yield drop for the last few days, back down below some key support areas on that yield, recent support levels. So it looks like the 10-year Treasury yield's rolling over. The volatility index, which was a big problem before, all of a sudden not as much of a problem. All these things we're going to go over and take a look at the charts. So why don't we go ahead and jump right into that. I'm going to start off with, first of all, letting you know that there's a big event coming up on Tuesday. We just scheduled it. So if you're a member and you didn't know anything about it, we didn't either until yesterday. But with everything that's been going on, I think this would be a really good time. Seeing lots more articles about go away in May, and I love to do these Mythbusters shows. And so if you go over to earningsbeats.com, you scroll down right in the middle of the page, you'll see Mythbusters don't go away in May. I'm going to talk on Tuesday, starting at 4:30 p.m. Eastern, about some of the signs that I'm seeing. I'm going to take a look at the forecast I gave back at the beginning of the year, talk about, is that still in play? Do we need to make some adjustments? All of that. I'm going to talk about a trading strategy that I used throughout earnings season. We talked about that last Wednesday in our trading room. And actually, I brought up two stocks, both of which did actually make money for us. And this is a trading strategy that I use quite often. It's a very short-term trading strategy, but I'm going to explain that. So it's just a lot to go over on Tuesday. And I think this would be, if you've never been to an event at Earnings Beats, I think this is one that you probably should be at. It is for our members only. Good news, though, there is a 30-day free trial, and the 30-day free trial gets you in. So make sure you get signed up for that. All right, so what happened last week? Let's get into the action. So I'm pulling up first just a summary of the 6 key indices that I like to follow. And if you look over here at the period, and I will pull this up so you can kind of see, it's just a 1-week period, and it shows them all in order of how they performed last week. So now I'm going to just shrink it back down a little bit so you can kind of see. The Russell 2000 gained 1.78%. The S&P 400 mid-cap, 1.17%. Same for the Dow Transports. The Dow Industrials, up 1.14%. NASDAQ, 0.97%. And the S&P, 0.55%. So everything was green. As I mentioned, going into the week, the first week of May tends to be extremely bullish, May 1st to May 5th. Of course, today is May 4th. Tomorrow is May 5th, so we're not going to have any trading those 2 days. But the first 3 days of the month, May 1st, 2nd, and 3rd, all performed well, especially cumulatively. And so I thought overall really, really solid action. We did get kind of a volatile ride on Wednesday after the Fed announcement. If you recall, at 2 o'clock, we didn't really do much for about 10 or 15 minutes right after the meeting, which was very odd. But then all of a sudden we took off. And that may have been when Fed Chief Powell, I wasn't listening to the talk at that point. But at about 2:15 or so, the market exploded for the next 45 minutes to the upside. And that may have been when Fed Chief Powell made his comment about the next rate movement likely would not be higher. In other words, rate cuts are coming. That's the way I kind of interpreted those comments later. And I think that's the way the market interpreted it, except it really didn't change anything. I mean, I don't think the majority of folks thought we were going to get a rate hike next. Everybody has been expecting a rate cut. It's just a matter of when we're going to get it. That's been the question, not if. So I thought that that whole big move from 240 or 215 to about 3 o'clock was maybe a little smoke. I didn't know that there was a whole lot behind it. And of course, the market came right back down. But we did gap back up on Thursday. And then, of course, with the Apple news Thursday evening and the jobs report on Friday, had a really nice finish to the week. But you can see small caps leading the way to the upside. Been seeing a lot of intraday progress in terms of the IWM versus the QQQ, which is the IWM tracking the Russell 2000, QQQ tracking the NASDAQ 100. Intraday, seeing a lot of rotation from the QQQ into the IWM that did kind of fall back a little bit late Thursday and especially on Friday. But the overall trend here for the last few months has clearly been a rotation away from the NASDAQ and into small caps and mid caps as well. Next up, I wanted to just show you the charts. This is the daily chart of these 6 indices. You can see the Dow, we did clear recent highs, but battling the 50-day. S&P 500 cleared recent highs, battling the 50-day. NDX cleared recent highs, battling the 50-day. Mid caps cleared recent highs, battling the 50-day. Small caps cleared recent highs. We were actually above the 50-day and came back down almost right to it at the close on Friday. And then the transports still weak on a relative basis, not able to clear the recent highs, but we did get back through the 20-day moving average. And that was something that we had been talking about. We had lost support, price support. We had failed at the 20-day moving average on a couple of occasions here over the past few weeks. And then yesterday, Friday, we were able to get back up above it. So at least a little bit of positive, but there's still more work to be done. And quite honestly, looking at these AD lines, they're still suspect. That's why at the open, I said, I'm not quite sure whether we're done to the downside just yet or not. Maybe we go back down one more time. I'm not sure. But I did see improvement. I mean, there's no doubt when you look at these charts, they're much better off than they were just a couple of days ago. And especially where we were in mid-April when the market was really getting hit hard to the downside and the VIX was rising. So things are much, much better than they were. Now we actually have room to the downside without breaking down. So taking on a little bit of weakness wouldn't really be as big a deal. Moving on to the sectors for the last week. Again, showing you that period. It's a 1-week period. So we're looking at the entire week. Utilities leading to the upside, gaining 3.35%, by far the best performing sector. Real estate next, then we had technology, discretionary, healthcare, staples, communication services. All these were on the plus side. The only 2 groups that were down last week were actually financials and energy, especially energy, losing more than 3.3%. So not a very good week for energy. Materials, you can see, were flat. So those 2 groups which had been performing really well during the month of April, at least on a relative basis, not so much over the past week. We're seeing energy give back a lot of those recent gains. Same goes for some of the other commodities, gold, silver, and so forth, pulling back significantly from where we were. Looking at the charts, so I pulled all the sectors up, candle glance for you. Now this is showing you, again, all the last 4 months of what's happened. It's not just looking at the last week. But you can see technology, when we looked at the major indices, we were doing well. We had gotten back up through some key moving averages, but the 50-day moving average was really what's been where we struggled. Technology, as we take a look at these a little closer, once again, above the recent high, not through the 50. Discretionary, not quite to the recent high, still struggling to close back up above that 50. Communication services, moving back up again, which is nice. Where did we finish? Right at the 50-day moving average. Industrials actually got back up above the 2 moving averages, and the 2 moving averages are almost sitting right on top of one another, 122.45, 122.65, and we finished at 122.77. So not bad action there getting back through, but we really still are in this overall downtrend. I think we need to clear probably about 123.5 to start to improve in that respect. Financials, making a move back up, couldn't get through the moving averages though. Staples, this one's still above the 50-day moving average, not ready to make that breakout, but this on a relative basis since the end of March certainly has been doing better than the overall market. And that's, by the way, that normally happens when the market is weak, which is what we saw throughout much of April. So nothing, earth shattering there. Healthcare trying to move up. This is still one of the weaker areas. The bounce has been much less vigorous, if you will. Trying to get through the first reaction high back here in maybe the third, fourth week of April. Haven't been able to do that. Sitting just below the 20-day, really nowhere near the 50-day yet. Real estate, also one of the worst areas. Did gap up, get through the 20-day moving average, but even with rates coming down late last week, you can see there was a lot of selling on Friday that took us back down to the 20. Hopefully, this is a gap up above the 20, holding the 20, and then we move higher. We'll see. Utilities continuing to perform well, though. The drop in interest rates, I think, also helping. So utility being helped by a couple of things here. Number one, the market had a sell-off. So anytime the market sells off, you're generally going to see money rotate into the defensive areas like we just saw with real estate and consumer staples. Same goes with utilities. But utilities was getting a second bonus the last few days of last week because interest rates were going down. And as interest rates go down, those income investors out there find the yields on these utility stocks to be more attractive. So if we're thinking yields are going to go down on the 10-year Treasury, utilities also get the benefit from that. So that helps to explain some of the strength there. Energy, mid-April topped. I said to be careful with energy. I said to be careful with materials, be careful with gold, silver. Not a fan of these. I'm going to show you some charts later in this show to help explain what I see there. But you can see energy is just stair-stepping lower. Materials doing the same. Energy got no bounce last week, as I showed you, down 3.3% last week, while most of the other areas were higher. Materials flat for the week. Had a chance to get back through the moving averages and wasn't able to do it, even though the overall market was strong. So cautious. That's all I have to say about energy, materials, gold, commodities in general. I think you got to be very cautious with them right now. All right, let's move on. I want to talk a little bit about the dollar because we just talked about energy and materials. This is a chart that I think is worth taking a look at. This is a chart of the dollar. This goes back 25 years. And when the dollar is declining, look at energy relative to the S&P going up. Look at materials versus the S&P going up. Then we went through this period sideways consolidation, and then the uptrend began in the dollar. So what happened? XLE versus the S&P, XLB versus the S&P went sideways until about the end of 2011. And at that point, when the dollar started going up, energy and materials started going down on a relative basis. Doesn't mean when I talk about, energy and materials and gold and the fact I don't really like them, it's not that I don't think they can go higher. Because every once in a while I'll get comments, someone will say, well, you missed the boat. Energy's been going up. Or that's not what I'm talking about. I'm talking about relative strength. And I'm talking about the long term, the big picture. As long as the dollar remains in this uptrend, which I believe it's still firmly intact, energy and materials tend to go lower in this environment. Now, you can look at this chart and you can say, oh, whoa, wait a minute. There goes the dollar up. And look, energy outperforming, materials outperforming. And then, we came down on the dollar and energy went down. So now it looks like we've got, more of a positive correlation between the two. You can go through periods like this. Look back to 2017. The dollar struggled all year long. Energy was weak. Materials were flat. They should have been going up, but they didn't. They were going down. But then the dollar turned up, and look what happened to energy and materials. So it's the big picture. So if I'm looking at this chart, let me annotate this briefly. But if I'm looking at this chart, what I'm talking about is this, just the general uptrend, and then this. Now, you can say what you want about the more recent period, but I don't think there's any argument that as the dollar's been going up, energy's underperformed and materials have underperformed. I think that's pretty obvious from this chart. So yeah, maybe in the short term, we've seen some positive correlation, but we've seen that in the past too. It generally doesn't keep going like that. So all I'm saying is to be careful, because since the end of 2022, since the end of the correction that we saw, or actually that was the cyclical bear market, this relative strength line's been going down. Materials have been going down. Look at the lows. The lows on the dollar are going up. It looks like it's starting to revert back to what we expected before. Dollar going up and these areas underperforming. So just be careful with that. Next up, gold. So a lot of folks really excited about gold. My goodness, Peter Schiff, he is really excited, beside himself, because he's been calling for gold to go up for many, many years, and it finally has. Anyway, here gold is, it's gotten to 2,300 or so. Back in 2011, it was right around 2,000. So it's probably up 15% since 2011. But look at gold relative. I don't have the dollar back up here, but look at gold relative to the S&P 500 since 2011. So again, it's not that I don't think gold can go higher. It's that I don't think gold is going to be an outperformer. And if I'm trying to beat the S&P 500, the last thing I want in my portfolio is gold, because gold does not beat the S&P 500 when the dollar's rising and when the volatility index is down. If you look at the spikes, I want you to look at the relative strength of gold. That's the middle part of this. It's this part right in here. This is gold relative to the S&P 500 right there. And you can see when the dollar was going down through 2009, 2010, even all the way into 2011, gold was a great performer relative to the S&P 500. And when the dollar begins a decline, a lengthy decline, the dollar will make, or excuse me, gold will make it'll make much more sense to be in long. Since 2011, since that dollar's been rising, look at the relative strength of gold. And as happy as everyone is right now about gold breaking out, look at what's happened. Since end of October of last year, gold relative to the S&P 500 is down. So yes, gold's gone up. It's made a breakout. But as I said at the top of the show, the S&P 500 went up 25% in 5 months. So even though gold has been, better and it's been making this breakout, it's underperforming. So let me ask you something. If I said, you could make 10% by getting into gold, but you can make 20% getting into the S&P 500, how excited are you going to be about making that 10% in gold? I'm not going to be overly excited. I mean, it's more than that. It's the S&P 500 has averaged going up 9% a year for almost 75 years. That's pretty reliable stuff. And when you're in a secular bull market, which is what we've been in since 2013, the last thing you want to do is to fill up your coffers with gold. Again, since 2013, this is when the bull market, the secular bull market in the S&P 500 began. That's when we took out the double top from 2000 and 2007, around the 1,550 level on the S&P 500. That happened on April 10th, 2013. Look at where we were at the beginning of April on gold relative, or excuse me, just gold absolute. We were at 1,600. So since then, we've gone from 1,600 to 2,300, which is nice, about 40%, something like that. We've quadrupled on the S&P 500. And we'll take a look at that in a minute. But look at the relative strength. I wanted to show you one other thing here on this chart. When you see the big moves to the upside in the relative strength of gold, every single one of them come with the VIX spiking. It's fear. Fear drives money going into gold as much as anything else. And so when the volatility index is surging, take a look at what gold does relative to the S&P 500. I mean, I'm not making this up. 2002 in the bear market, we had the VIX going up. There's relative strength in gold. VIX goes up. Here's that relative strength in gold. How about 2006? We saw the VIX spike up to almost the 20 level. And just that little spike right there, look at gold relative to the S&P 500. How about starting in 2007 through 2008, through that financial crisis and that secular bear market? The VIX shot up. Gold soared versus the S&P 500. How about 2010? We had that one big surge in the VIX, one big surge in gold relative to the S&P. And then from about April 2011 through the end of the third quarter, we had another big surge in the VIX. What happened to the gold? Big surge. And then almost every spike that you look at here, even ones that just go back up to about 20 or 25, if you look at them, gold outperforms during those periods. The pandemic, right there, gold spikes. How about the trade war at the end of 2018? Right there, we had the VIX going up, fear. And what happened to gold? It outperformed at the end of the year. So these spikes that we've had, we just had one where we went up to 20. We got a little bit of a spike in gold. It's already rolling back over because the VIX is coming back down. So let's take a look at the VIX. Do you remember where the VIX was at the end of October? It was up in the low 20s. And remember, that was the end of the correction. The 2023 correction ended at the end of October. Remember, we took off in November. Look at what happened to the VIX late October through the month of November and into December. During that period, what did the stock market do? It exploded to the upside. Look at what just recently happened with the VIX. We topped. We didn't. This is showing 21 and change. I never saw it above about 1950 or 1960. But anyway, we topped up near 20. What happened in April when the VIX was going up? Gold was outperforming. The stock market was going down. I mean, that's normally what we see. But look at what has happened now on the flip side. That VIX has come right back down. And this is what I'll tell you about the VIX. If a lot of folks thinking we're, in a bear market or getting, going into a bear market, and this is just starting. During every single bear market decline, every single one of them, the VIX has shot up above 20. The difference with this one, none of the other bear market declines ever saw the VIX come back down during that period of decline. Never saw that VIX come back down below 17. Never. Not once. It's one of the things I talk about with the bear market. When that VIX remains above 17 and shoots through 20, that's when you've got to be really careful about the stock market. Look at what we did. We came right back down like a hot knife through butter. 17 did nothing. We went right back down. Folks, we're still in a secular bull market. You can call it what you want. You can dream about it being a bear market. It's not a bear market. This is the conditions, the environment. It's like going outside and seeing a couple clouds in the sky and swearing we're going to have a tornado. The clouds are already scattering. I mean, there's no tornado. Here's another chart of the VIX. This is one I've shown multiple times, but it shows you how the S&P 500 performs when the VIX is at various levels. And so here's the annualized. This is only during the secular bull market that we've been in. So this dates back to 2013, that April time period. Anyway, the S&P 500, when the VIX closes above 20, the days where the VIX closes above 20 works out to an annualized return of minus 36.74%. When you're between 17 and 20, the S&P 500 annualized return is plus 15.29. When you're between 13 and 17, which is where we are right now, the annualized return jumps to 30.97. And when we go back down on the VIX below 13, the annualized return for all of these days where we've closed below 13, 47.26%. So when you go back and you look at that VIX and you see that big decline, you should embrace that from a bullish perspective. This is huge. I said, a couple of weeks ago, one of the things that really worrying me was the VIX. And if the VIX got through 20, I was going to move to the sidelines. Never got through 20, never closed above 20. And I don't think even in intraday, I don't know where that candle came from because I watched it intraday. I never saw the VIX go above 20. But anyway, right, 19 and a half comes right back down, and now we're sitting at 13.48. 13.48. We're getting close to this level where we go back down and we take off. The last time we saw this happen at the end of last year with that big drop in the VIX, you know what happened with the S&P 500. S&P 500 absolutely soared. That's what started our 25% gain. So you've got to respect the volatility index. When it's coming down, essentially, see, the two things I like, the two sentiment signals that I really like to look at are the equity only put call ratio, because that's telling me, it's giving me a sentiment indicator that relies on retail traders. That really is all about retail traders, the equity only put call ratio, just showing how crazy bullish folks are. And that's what they were back at the end of 2021, right before we had a cyclical bear market in 2022. I talked about it. It was the number one factor in me saying at the beginning of 2022 that there was a very, very real likelihood that we would see a cyclical bear market in 2022. And I thought we could go down as much as 25%, all the way back down to 30. I think I called for 35, 3,600, and we ended up going to 34.91. The VIX and the sentiment, I mean, especially the VIX and the CPCE, equity only put call ratio, those were the two things I was looking at, especially the equity only put call ratio. But anyhow, when the VIX, the thing I love about the VIX, so we got the equity only put call ratio tells us what's going on with the retail trader. The beauty of the VIX is that it's based on the premiums on short-term S&P 500 options. Who sets those options? Market makers. So market makers, by following the VIX, it's giving you a better indication of what they see ahead. And here we're talking about a part of these big Wall Street financial firms, Goldman Sachs, Morgan Stanley, even like JP Morgan and Citigroup, and all of those types, they're basically giving us a signal. And when the VIX goes down, it's telling us they're willing to price options cheap. Why would they do that? Because there's not going to be much volatility. And if there's not much volatility, one thing history tells us is that stock market's going up. So you do what you want. But I'm telling you, that drop in the VIX last week was a signal to me that, you know, we may not have another low coming. And if we do, my guess is the VIX doesn't get back up anywhere near 19 or 20. But let's see how it plays out. Here's the equity only put call ratio. And this is what I'll say about the beginning of 2022. This was the signal that I said this was the biggest problem in the market. I mean, we were talking about inflation back then and higher interest rates and, you know, the Fed and what they were. I mean, we had everything going. We also had rotation into defensive groups at the end of 2021. And I said, you know what? All of that is bad news for the market, but it still ain't the biggest news. The biggest news was the fact that this 1 year moving average of the equity only put call ratio had gotten down to the lowest it had ever been going back the last 17 years here. You can see we never went this low, which tells us that the retail traders were going in hand over fist into these options. On the call side, they were so bullish. And if you remember, with the pandemic, we had a whole new set of traders coming in. We had to stay at home. A lot of people were finding the stock market as a part-time job. Why? Because the market was just going up every day. And it got to the point where literally traders were using the stock market as an ATM machine. Felt like nothing could go wrong. We're just going to remember all the memes and the chat rooms and everything that were going at the end of 2021. Everybody was just so bullish and giddy. When we turned higher, when this started to turn higher going into 2022, look at what happens when this rises, when this 1 year moving average of the equity only put call ratio is on the rise, the stock market struggles. On the rise, 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 stock market struggles. Do I need to beat you over the head with this? When we are turning up from low levels, you've got to be very, very, very careful, because what this is telling us is that everybody has piled in. There's no more money. Everybody is in. They're borrowing. They're doing everything they can to get in. The masses get it wrong when you get to these extreme levels. They paid the price. I said at Market Vision 2022, people were going to pay the price, and it was going to be ugly. And I felt bad throughout the whole bear market, because you had analysts and everybody on CNBC say, oh, it's just a pullback. January, February, it's a pullback. Another great opportunity to jump in. And then by the time things really got ugly in May and April, or April, May, and even into June, that's when I thought most of the damage was done. I started calling a bottom, and that's when everyone else started getting bearish. And you can see, look at the bearishness that we saw. Now we're seeing the opposite. Now we're seeing this equity only put call ratio reach an extreme level. Everybody is so bearish, the market can't possibly go up. Right? That's what everybody was saying. We're going to just play these puts into the, I mean, it's easy money. Well, we're rolling over. Do I need to show you what happens when we roll over and we start going lower? Down, nice bull market move. Down, straight up. Down, straight up. Down, straight up. And now we're going down. What's the market doing? Straight up. Folks, we still have a high level on the equity only put call ratio. Again, do what you want, but these signals I've been living by for years, and there's nobody that's called the market better than we have. I mean, I'll throw that out there. If somebody's got a track record and they can prove it, I'd love to see their track record of calls over the last 5 or 6 years, because I don't think anybody in the market's called it the way we have. And these are some of the signals that I use. So again, VIX dropping, equity only put call ratio still high. Where do you think the market's going? You want to go away in May? I don't know. Good luck. 10-year Treasury yield last week. There you can see the drop the last 3 days, dropping below these recent lows, dropping below the 20-day for the first time in about 5-6 weeks. Probably heading back now to test probably an area, I'm going to say around 435 to 445. You got the 50-day moving average right in the middle of it, about 438, 439. What happens? Where do we go from here? I think the 10-year Treasury yield is normalized. I don't think, first of all, this is more likely to move with the economy than it is with what the Fed funds rate is doing. This is longer term. It's a 10-year Treasury yield. So yeah, the 1 month treasuries or treasury bills, or maybe 3 months, or even the 2-year might have a little bit more tie, especially the 1 and 3 month, to the Fed funds rate. But these longer term yields are much more dependent on inflation expectations and our economy. And I think it's normalized, and we're probably going to sit in the 3 to 5% range on the 10-year Treasury yield going forward. If we get through 5, obviously we'll have to kind of keep an eye on that. But otherwise, I think this probably be back in this 3 to 5% range is where we're probably going to hover. Let's see. Next up, I wanted to show you one of the charts that I had back in, this was on, what day was this? April 10th. So I showed a chart of Apple and how I believed it was being accumulated. And I'm going to pull this chart up just so you can see what I was looking at back then. So right here, this period, we went through beginning of 2024 through the middle part of April. I highlighted it because what I did is I went back into the intraday action to see, I mean, clearly Apple was going down, right? I mean, that's a no-brainer. But how was it trading throughout the day? If we go back to 2022, when I called the market bottom, one of the things I saw was that the QQQ, the Spider, they were all going down in June. But what we were starting to see was a lot of early morning weakness. We'd get gap downs. We'd get selling in the first half hour, 45 minutes, and then boom, we'd get buying that would come in the rest of the day. And so even though we kept going down a little bit, it was starting to show signs of major accumulation. When I looked at Apple at the beginning of this year, I saw the exact same thing. So look at the opening gaps. Again, let's try and get this big as I can there. Opening gaps during this period, we dropped $23.89. All the gaps, if we added them up, the gap ups, the gap downs, the cumulative gaps throughout this entire period, down $23. The first half hour of trading, down another $10 cumulatively. That's $33, $34 that we were down either between gaps or the first 30 minutes of trading. Well, if you look, we went from 192 down to, at this point, just under 170. So we went down about $22 or $23. We went down $34 cumulatively between the gaps and the early morning trading. So look at what happened the rest of the day. 10 to 11, we still went down another buck or so, $1.65. 11 to 2, we went up $7. 2 to 4, we went up $6. So during this period, the 11 o'clock to 2 o'clock, or excuse me, 11 o'clock to 4 o'clock time period, 5 hours out of the 6.5 hour trading day, those 5 hours actually showed Apple going up $13. I mean, doesn't that seem kind of odd to you? That we went down $23 during the first 4.5 months of 2024. And yet the final 5 hours of the day, actually, we went up $13. Who's buying? Because we're in a downtrend. Everybody's talking all horrible about Apple. Who's buying it? Wall Street. Why did they buy it? Why did they buy the QQQ and the SPY back in 2022? I think you know the answer now, because we were going to go back higher. Well, that's what I was pointing out in our Earnings Beats Digest for April 12th. I mean, this newsletter it's a free newsletter. If you're not already getting it, I don't know why. There's some excellent information that we share with our free community, just as we do with our paying members. But I bring that up because, well, before I show you the chart, I'll show you one more time. Don't go away in May, coming up on Tuesday. Make sure you go to Earnings Beats and sign up. It's free. You'll have to give credit card, but you'll get 30 free days of our service. And we will remind you before your trial period is up. Because if you don't want to be a member, we don't want you to be a member. I think you're going to love our service, though. So make sure you try that out. But if you scroll down, here's where you can sign up for our free newsletter. No credit card required on this one. You can unsubscribe at any time. But just doing that, you would have had the information I shared on Apple. I didn't know when. Excuse me. I didn't know when Apple was going to turn up, but I did feel strongly that it was being accumulated and it would eventually turn back to the upside. Here was earnings on Apple. Now look at what happened. So now all of this downside action, I mean, literally we had opened 2024 down and we opened it about 187. Yesterday, Friday, Apple after earnings opened at 186.65. So all of a sudden, after all this accumulation takes place, we get an earnings report gap up that takes us all the way back to where we were at the opening bell at the beginning of January. Pretty amazing, isn't it? Wall Street, they were accumulating while everyone else, everybody coming on CNBC, what I like to call the influencers from Wall Street. Then you got the back office, the market makers doing their thing, going opposite what everyone else is doing and making money. And then they've got their influencers going on to CNBC. Why? Because so many people watch CNBC. So, I don't know for any fact that there's any kind of collusion going on, but I just find it odd. I mean, is there a bigger conflict of interest anywhere in the stock market than having a firm like Goldman Sachs that has a market making unit that takes the opposite side of what the masses are doing and yet sends analysts on the CNBC and tells you what to buy and sell? I don't know. It seems like a pretty ridiculous conflict of interest to me. But that's the market we have, and that's the market you have to trade, and that's the market I have to trade, which is why I do things like that Apple chart, looking for different signals to find out what Wall Street really is doing instead of listening to what they're saying. Anyhow, that's basically what I had for this week. I mean, I know I went a little bit long, but I also had a lot to vent. Didn't have a show last week, so giving you a little bit more of your money's worth here, which is hopefully this is worth your money that you put up for this, because it's zero. It's a free video. Anyhow, please, I would love to have you come in on Tuesday at 4:30 for our next Mythbusters video. Instead of go away in May, you might want to think about don't go away in May, and I'll tell you why on Tuesday. Have a great day, everybody. Happy trading.